fact sheet. Here, if it's not a fact, we don't discuss them. After a long battle between the political parties to gain the mandate to the people of Ghana to rule over them, the NPP, per the declaration made by the Electoral Commission, emerged victorious. After going through Parliament and the members of Parliament being sworn in, His Excellency the President was also sworn in to complete his second mandate, which is a 4-year term. That 4-year term requires that the President meets the manifesto promises he made to the people of Ghana. This includes hospitals that have to be built. This includes educational facilities that have to be built as well, the roads, and several more. Issues to do with security, issues to do with the economy, issues to do with the general welfare of the people of Ghana. But that mandate and its ability to be funded is a matter that we are discussing this evening on Fact Sheet. My name is Samuel Ishen, and tonight, the focus of our conversation is how the NPP administration within the next 4 years is going to fund all of its manifesto promises that it made to the people of Ghana. Considering in 2020, some of the ratings that have come for our nation, Ghana, where some, ratings that put us negative and many more, how are we going to fund our economy and the projects we intend to embark on? Would the government be approaching the fiscal consolidation road, or would it be approaching the process of spending more to stimulate growth in the country? If it decides to go on the path of spending more, question is, where would we be getting the money from? Considering again that our debt to GDP ratio, as of last year, was around 76.67%, which had become a matter of concern for many economists and financial analysts. Our debt portfolio as well stood around 263 billion as of last year. So with these things hanging on the neck of government, how would it be able to spend more to stimulate growth in our country? Again, with coronavirus still, wreaking havoc across the world, the places where we would usually go to for funding, most of the nations are going there for funding. Maybe if we decide to issue bonds, how easy would it be for us to get good coupon rates for the bonds we shall be issuing? If government decides to go the path of fiscal consolidation, then obviously growth would be a matter of a difficulty. If it decides to go the route of taxation, it would also be a matter of a concern for Ghanaians. This is what we are concerning ourselves with this evening on Fact Sheet. Stay with us as I introduce to you my guests in a bit. You're welcome back. This is Fact Sheet live on eTVGhana, live on Facebook, Twitter, and Instagram as well. I encourage you to join the conversation and to share the link to other groups and platforms you may belong to. Tonight, my guests to help me discuss and interrogate the issues are Professor John Gachi of the UCC, Dean of the Business School. He joins me for this discussion. So is Dr. Lord Mensah also joining me, University of Ghana Finance Department Senior Lecturer, to share his thoughts with us as to the route government must consider going in terms of how it will be funding its projects and the manifesto promises it made to the people of Ghana. Professor John Gachi joins us via Zoom this evening, and Dr. Lord Mensah is in the studio with me. Doc, Prof, good evening and welcome to the discussion.
Yeah, good evening, and good evening to our viewers.
Good evening, and thank you for having me.
All right, so I'll start the conversation with you, Doc. We are talking about government and the options that are available to it in terms of funding its manifesto promises it made to the people of Ghana, considering other factors, what's happening around the world when, countries are, shutting down as a result of either the second or the third wave of coronavirus, and our own situation in Ghana, considering that for the past 4 years, government's budget, it has read to the people of Ghana, has shown that its ability to meet its revenue targets have always fallen short. What options are available to government?
Yeah, I mean, this is a straightforward question that you've asked me. Options available to government. Now we need to go back to history as to how government has been financing its, activities. And if you look at our revenue generation structure, clearly you will see taxes, you're going to see debt that we borrow to finance, we're going to see grants, we're going to see other sources of funding from, export and oil, export and all those. And clearly, these are sources that fit into our revenue pairs. And the more you generate, the better you can easily spend. And if you look at the sources, clearly you could see that things are, tough. Now, if you take revenue in terms of maybe oil export, I mean, we're here that we saw oil price, on the global market coming down. So if oil price was around $60 per barrel, and now it has dropped to about, even 35 or let's say 30, clearly gives you the signal that, I mean, if you're exporting, you will not get much as, expected. Again, if you have to look at the Eurobond market, this is a time that the future, even the next day, is very, very uncertain. I mean, and those Eurobonds that we go and borrow from those markets are purely people's pensions here and there. Even though they are comfortable with the coupons that we normally deliver, because sometimes we provide coupons of about 7.5, sometimes 10% and all those, which clearly gives you the signal that, we are giving way, above what those European environment can give. And, with the European environment, their interest rates are in the single digits, sometimes 1.5, 2% and all those. And I have a friend in Switzerland. He is in charge of, African bonds that so one of the big European banks deals in. And he tells me that, Lord, do you know why we are happy with the bonds that, Euro bonds that you guys issue that we buy into it? Because he said just one coupon payment, it's about 10 years of, interest payment in the environment. So when we issue bonds and they buy into it, we shouldn't think, oh, they are so happy with that. But they are aware, I mean, sometimes the bond's life maturity will be around, let's say, 13 years. But they know very well that by the 5th year, they are comfortable. I mean, even if you pay or you don't pay the rest, they are okay. Then these are environments that they are also struggling. And in the end, I mean, looking at tomorrow becomes a problem. And then let's also look at grants. Grants are, monies that are given by our development partners and all those. And those ones, fine, you can be sure it might come. But what percentage does it constitute in our revenue pairs? It's just about 1% to 2% most of the time, in the past, as you can see. So clearly the main channels, and then let's look at our local environment, the taxes that we generate here. Clearly, like you indicated in your introduction, government over the years has been struggling, in its revenue target. And the questions that comes into mind most of the time is whether the revenue target that we set are realistic or not. And then also, we also look at possibly, if we are not hitting the revenue target, the investment that we've made to enhance revenue collection, are they yielding? If they are not yielding, what is not making it yield? For instance, we did what we call it investment in the paperless port, which we expect that it will feed into our revenue generation in terms of the duties that, and then all those revenue that we generate at the port. And then also, we did some digital address systems. We had, identification cards and all those. And we're expecting that, we can put all this together and then build up a system. And with that system, we should be able to enhance our revenue collection. But maybe we are yet to see that. Let's see how things unfold going forward. But I can tell you for a fact that, going forward, things will not be that easy. Now, if you look at financing, anytime somebody asks me a question of, how do you think the government is going to finance? I'll ask myself, what will be the posture of the government going forward? If the government assumes that aggressive posture, like, the way we found ourselves in COVID and we still saw some spending going on, obviously it will be tough. But then if government should assume that, conservative posture, knowing very well that, okay, hey, election is gone, at least I'm in power already. In the end, we had some projects that were ongoing, projects that funds have been earmarked for. I have to make sure that all this project comes toward to see the light at the end of the day. Then we can go forward with kind of that conservative posture. In the end, it will minimize how aggressive we are in our fiscal space. Because if we should go in that direction of, okay, fine, I mean, we are not raising that much, in the end, we have the Fiscal Responsibility Act. We can find a way to maybe, review that fiscal responsibility as though we can have space to borrow more. Then in that case, it's going to be tough for us. But I'm assuming that looking at the space, I mean, the global space that we have now, with the current things that are happening, COVID coming in and all those, we have gone away with the election. I'm expecting that kind of a soft posture as far as, spending is concerned, so that more or less we'll be close to, what we generate in terms of revenue.
All right. Let me speak to Professor John Gachi, who is joining us via Zoom, and pick his thoughts on what government must be considering in terms of preparing to spend and also make some revenue. Prof, what should government be considering at the moment in terms of how you're going to spend and how you're going to make money?
Thank you. I think this is very low. I can't hear. All that you discussed, I didn't hear anything. Right. So I think you need to work on your volume.
That's fine.
Why? I think the best approach is for government by now to outline what they consider to be the most appropriate model they are going to use to raise financing for their activities. It is only sad that as at now we have not heard anything. Bearing in mind that government is well aware of the difficulties in 2021 and for the greater part of the 4 years ahead of us. So one expect that by now they should showcase or demonstrate some level of awareness as to what they seek to do. Then we will have the opportunity to discuss. But as it stands now, I think the best approach going forward is efficient expenditure. Efficient expenditure is very, very key. That is to say, what you are going to spend, the small amount of revenue that we are going to mobilize, what you are going to spend it on, is it going to inure to the overall interests of the economy of Ghana? That is what I mean by efficient expenditure. The outlay of expenditure or the envelope of expenditure that you put forward, is it something that our revenue that we mobilize or we are expected to mobilize will be able to finance? I think that is the approach that I believe government should adopt as we go along. But I do not think that the posture of the government would change the financing model significantly. From 2017 up to date, much of the financing of the government has to do with excessive borrowing. Between 2017 and 2020, we are talking about 140 billion Ghana cedis borrowed. Now, if you also look at the expenditure in advance of appropriation that was read in November, you will also clearly see that the approach has not changed. We're supposed to borrow $5 billion and we're supposed to spend about 7 billion Ghana cedis on interest payment, and the rest is supposed to be spent on amortization and clearance of arrears. And we're supposed to be spending about 7 billion on compensation. And as usual, we're supposed to be spending less than we are committing to interest payment of just around 1.9 billion Ghana cedis. When in total, incrementally, we have been paying between 19 billion up to 22 billion from 2017 to 2020 in interest payment. So I do not see the government coming out with a different model of financing activities. It will still continue to be borrowing, depending on the dwindling revenue from natural resources such as the solid mineral sector, and from oil and gas. Even though we do know that prices have gone down significantly, but most of the activities were actually predicated on the funding from the ABFA, and that will not change. I think the government has indicated there is something called 100 billion Ghana cedis something care. That is also about borrowing. It's not about anything else. It's also about borrowing. So what it means is that borrowing will be a greater part of financing of the government. Of course, one is expecting that more innovation is needed in order to bring on board revenue and at the same time capital for financing government recurrent expenditure and capital expenditure. So that is my view on how the government will be looking like in terms of financing, as demonstrated or as given in terms of prelude to 2021 by considering the first 3 months budget that have been presented by the same government.
Now, the point you make about borrowing and the fact that the sources we are looking at, does that not bring in the concerns we had in 2020 when we started talking about, how we are being pushed to the point of becoming highly indebted poor countries and the threshold we are in now? Would it not be pushing us in that direction, considering our debt to GDP now and our debt portfolio?
Well, I think that is very clear. We do know that our debt to GDP ratio has gone up from 2018 after the rebasing. It has been moving up significantly. But I am not concerned so much about the debt to GDP ratio. The reason is that in reality, you don't go to the market to borrow debt to GDP ratio. You go to market to borrow a certain level of debt, and your interest is paid on that level of debt. So even if you borrow 140 billion, for example, and your debt to GDP ratio is 20%, it's not the 20% you're going to pay. You're going to pay interest on the 140 billion. And remember, our financing structure in terms of debt management has changed since we became a lower middle income country. What it means is that concessionary loans are not available for you. So all the borrowing we have been doing since then, about 99% of that borrowing, normally we say we are going to the bond market, has some short-term implication and put pressure on us. If you go and borrow through bond, you are likely to pay semi-annual coupon, annual coupon, or quarterly coupon. Now, if you take semi-annual coupon, what it means is that if you go and borrow $1 billion, after 6 months, you start paying the coupon. Okay? So that is why our repayment burden continues to increase. So you borrow, and within a short period of time, you are encumbered with repayment. Okay? So that is what is the problem we are facing. So if we say we are going to the bond market, so we are borrow, even the interest rate is good, etc. But immediately you're committed to paying some coupon, depending on the arrangement. If it is annual, it means that at the end of 1 year after borrowing, you start paying the coupon, as opposed to a concessionary loan like the one we got from the IMF for COVID purposes. You took $1 billion. You was expected to pay after 5 years. That is the moratorium given, and it's zero interest rate. So that gives you some respite, okay? But that is not the case with the bond. So sometimes when we are saying that we are going to the bond market, we are borrowing this here and there, it comes with a lot of burden that perhaps the finance ministry will not tell you that this is what we are going through. And that is the reason why we are making in excess of 22 billion Ghana cedis as interest on loan for 2020 alone. When we are committing just around 9 billion into capital expenditure, it is because of these things. So yes, those fears are there. But if you look at the things that the government say, especially from the finance minister and the rest, it doesn't seem that there is any immediate avenue apart from borrowing. So that is what they have made us to believe. And that's why I keep saying that up to now, we have not been told as to a different approach that will be used to bring in capital to support long-term activities of the government, and for that matter, to rake in more revenue to support recurrent expenditure in terms of a compensation, goods and services, etc., which we do know is taking a chunk of tax revenue of the country and leaving the country with very little to support development activities.
Look, let me come to you and ask the question about sources of funding, because from the picture you paint locally, it's virtually impossible to raise money locally. And then externally, we would have to go in for some of these bonds, which are high coupon rates. Is that not where the concept of collateralization of our mineral resources comes in? Where, you know, we collateralize, we take some money to develop our nation. Yes, we develop our nation, and then later on, we are able to have some respite to, you know, embark on the project that will be able to yield some revenue in the future for development.
Yeah, that's fantastic. I mean, if you look at the concept that, for instance, the Japan came up with, I mean, it's more or less equity financing, where you realize, I mean, your value for minerals and then take upfront, you know, money, looking at, you know, deferred cash flows that will come later. I think is one of the best innovative ways of financing. But then apart from the questions that has to do with valuation and then also the advisory and all those, I think the concept was very, very, you know, good. It's one of the innovative ways which we can use, you know, to rake in revenue, I mean, to avoid this unnecessary borrowing that we've been talking about here. But hey, let me also look at why we relate the debt to our GDP. This is very, very important. I was expecting that, you know, we would rather relate it to, you know, our revenue generation, because you have to pay for the, you know, the debt in future, and at the same time, you know, the coupons that goes with it that are more recurrent. I mean, annually you have to be paying. And the reason being that when you borrow, you invest into your economy. Now you ask yourself, how much are you generating to pay? So the GDP forms, you know, the economic output. In the end, the more your GDP, the better for you in case, I mean, you accrue more, you have to accrue more debt in the future. Now, I'm not comfortable with the GDP because maybe the GDP you might value the economy, but then the economy might have some sectors that are not really contributing to revenue generation. So I would prefer that, okay, fine, we are accruing debt, but how is our revenue doing? And of course, we are all, you know, witnesses of how our, you know, revenue is shrinking over the years. Now, effectively, that is why I always go by the posture of the day, you know, as far as, you know, the government is concerned. Now, if you look at a situation where you are generating less, and you know very well that it will be more expensive for you to borrow, and especially when you've adapted, you know, debt reprofiling strategy, a strategy where you've deferred most of your debt, push it backwards, a situation where you've borrowed, you know, long term to pay for your short term debt, then you have to look at possibly I shouldn't incur more cost in borrowing, because if it turns up that if all this debt that I've deferred, in terms of principal payment, start, clustering in terms of their maturities, the country will start struggling. Then it means you have to come back to the drawing board and, adapt the conservative nature, a nature where at least you'll be close to your spending. And that's when I was happy when IMF came in and they restricted us to that 5%, and we had to pass, a Fiscal Responsibility Act to hold on to that. But were we able to maintain it? We couldn't. Because in the last, budget review by the finance minister, he indicated that he has to repeal that law, that Fiscal Responsibility Act, that at least it will give room for, a budget deficit of about 11%. So we can easily, spend more. And if you are spending more and possibly you're looking at your local environment, you see, government has the tendency, to attract funds if it goes to the market to raise money. Now, just before the elections, around the elections and immediately after the elections, getting into December, government made an attempt going to the market. They couldn't meet the target through treasury bills. And the signal. It tells you that even the next 3 months, which is the barest minimum borrowing maturity for the 91 day, the investor is uncertain. And who are those investors? These are banks, financial institutions that lend money to the government. Now, the table has turned. If you look at recent, last 2 days, 3 days, they said the government has been able to meet its target as far as what, treasury bill funds is concerned. But then you ask yourself, at what interest rate? The interest rate is very, very important. That is why, when you are financing and then you come up to say, okay, fine, the government has, gotten over subscription as far as its bond issues are concerned. You ask yourself, at what rate? The investor is sitting somewhere. You need to understand what is the commitment level of the investor. Maybe the investor has a huge portfolio and they are committing a certain fraction, let's say about 20% of it, into your environment, and you are giving them maybe 7.5, right? Every investor will go for that. But then in the end, we need to ask ourselves, what cost are we going to be able to, hold on to this in terms of our revenue, a situation where revenue generation is becoming a problem. So for me, I would have, adapted that posture of what? Because the IMF restriction on our, the gap between what we spend and what we generate, is more or less to tell us that, hey, be careful, don't be too aggressive. Don't spend and spend and spend when you cannot match up with your revenue. Just close the gap to a certain point, and in the end, manage to a level where you think you can generate enough. When your prospect of revenue generation is good, nobody tells you don't go and borrow. If the signals are there, all the investment that we've done, building up into revenue, is yielding, and we see all the projections coming up, giving us upward strength. Clearly, you have every confidence to go to the market to borrow, and even the interest rate might not necessarily be a problem. So for me, it's time that we adapt that, conservative, nature, where we spend close to what we generate.
All right, let me ask Prof a question about, what we have been able to secure, let's say in terms of bonds that we have gotten, and where we invest the money we have gotten. As if you monitor over the years, most of government spending has gone into social interventionist programs. These are programs that do not necessarily yield income that can pay for themselves and also offset the loans that we have gone to take. And so government therefore would have to go and borrow again to service the loan that it had previously, gone for. Should that be a matter of concern for us, Prof?
Well, I think it's a matter of concern where it becomes necessary to engage in social intervention that is good for a segment of the economy. But there must be a balance between the portfolio of social intervention and investment in some key areas of the economy that will actually continue to keep the economy going and generating revenue. Remember, whatever borrowing you do as a state, what you have engaged in is that you have collateralized future revenue against today's borrowing. Because when you borrow, you don't pay today. The reason why you are borrowing is that you expect revenue. So revenue is actually collateralized against borrowing is actually collateralized against future tax revenue or revenue in general. So if you spend all your money on social intervention, it may make you popular among self-segment of the population, but the burden it brings to you as a manager of the economy is such that you cannot manage it for long. See, that is the challenge. So yes, we agree that there should be some level of social intervention in the economy, but that level of social intervention should be matched with your investment portfolio in other important sectors of the economy, so that the economy will be active. The economy will be active in the sense that you'll be running an economy that is able to generate revenue. You'll be running an economy that is able to create new opportunities. You'll be running an economy that is able to allow people to access new opportunity to create jobs and add on to revenue generation. And if it is the base is not like that, no matter the level of social intervention, you cannot sustain it. So I think that is the point I believe we need to appreciate. And when we appreciate that, we will be able to balance things. We will be able to bring about efficiency. We'll be able to bring about the cost-benefit analysis. We'll be able to look into the future and see all the programs we are running, is it sustainable into the future, and is it protecting the future of the economy? I think that is the way we need to go about it.
Now, we've been having the conversation, Prof, in absentia of the role that the private sector also plays in all this, because if the conducive environment is created for the private sector, that's when they are able to expand, grow, and then employ more people, and then the economy is stimulated. Now, I'm looking at the people who are going to empower the private sector to grow. That person who has, a water bottling company, that person who has a transport company, who wants to buy more buses, obviously would have to go to the banks for some money in order to be able to expand, to create more wealth, to pump back into the system. But over the period, we have seen monetary policy rate coming down consistently, yet it doesn't reflect in the amount of interest that businessmen pay at the banks. Should the finance minister, in planning how to spend money and to generate revenue, be considering ensuring that the banking sector, especially with the cleanup exercise that we are told, empowered the banks to be able to do more?
Well, I think it is fundamental that we consider the financial sector and the banking sector as the lifeblood of the economy. When your financial sector and the banking sector is not responsive, is not sound, and is not robust, it cannot support economic activities. It cannot support entrepreneurial drive. It cannot support people's ideas. It cannot support, the growth of businesses. So that is basic fact. And that is why, as a government, there is a need to invest in ensuring a sound financial and banking system. There is a need to invest in a stable banking and financial system. And there is a need to manage the economy in such a way that the financial and the banking system is able to mobilize funds within the system to engage in effective intermediation process. Whereby,
let me pause you for a second and ask this question. The banking and the financial sector, do you think they are on sound footing for the next phase of the government, agenda?
Well, if we want to base our argument on what Bank of Ghana tells us, then it means that there is some stability in the banking sector. It means that there is some soundness in the banking sector. But whether or not the banking sector is stable, is sound, etc., the key benefit of that is how it responds to the economic needs of the economic units of the country. How much is the asset base of our banks put together, our financial institutions or put together? So that is a critical question we need to ask when we are dealing with this matter. All the banks put together, how many big ticket items can they finance when they do arise? Those are the issues that I believe we need to look out for. There is a layer within the financial sector. The layer is such that those at the lower end will have their portion within the financial sector being stable, sound, and robust and responsive. The question we ask ourselves is our micro finance sector stable, sound, and responsive to be able to finance micro and small businesses with microcredit and some level of funding for that segment of people who engage in economic activity. When you come to our savings alone, are they sound? Are they stable? Are they responsive in terms of the needs of businesses that go a notch higher than micro businesses, etc., for which those entities are in position to supply credit at cheaper cost to this segment of businesses within our economy? Then you graduate it to the commercial banks and what they are able to do within the framework of stability, soundness, and responsiveness to the needs of the segment they serve. We're talking about the government, we're talking about businesses which are large in nature, etc. That we are not able to achieve. And that is what I think we should be able to, set our eyes on to achieve. Because without that, you can have a banking sector which is sound by your criteria, which is stable by your criteria, but it's not as responsive enough in terms of what the business community, in terms of what entrepreneurs need to engage in economic activity, to contribute to job creation, to contribute to revenue generation, and then to contribute to the enlargement of the economy and sustainability of the economy. I believe that should be our interest when we are discussing the banking and the financial sector. But if we pitch camp only with the idea that there was a banking sector cleanup, and we have spent 21 billion Ghana cedis on the cleanup, and now the banks are stable, and that is the end of the story, then it means that we do not want to prop up the banking sector, and the product of that activity should be its responsiveness to the general economic activities in terms of provision of credit and funding.
All right, so we'll go for a short breather. When we come back, a simple question to my two guests with me, and that has to do with the fact that our economy is import-driven. The informal sector virtually is the base of the economy. Would COVID-19 allow for all of these plans that we have discussed this evening to happen? We're taking a short break. When we come back, that's what we're talking about. We have 10 more minutes before the show comes to an end, and Doc, I'll start with you. The question of an import-driven economy, which would see its businessmen not being able to travel to the UK, for instance, as a result of COVID-19, which would see its businessmen not being able to travel to several other places where they would go and import things into the country. Would COVID-19 allow for us to see to the realization of all these we've discussed tonight?
Right, that's a very good question. But before then, let me take a shot on what we're discussing before the break on
social
the
interest
rate and the banking channels.
Okay, all right, that's fine.
I mean, clearly, on the grounds, if you look at the manifesto of the administration, I think they've realized that, the rate at which government was borrowing it's also affecting the interest rate reduction. Now, you know, if you take government borrowing, government has the affinity to attract funds. Now, if anybody should go on the market to put his money, I mean, in investment, he's looking at the possible returns that he will make from a safe haven like treasury bills, which is more or less lending to the government. And then the alternative investment he'll have, maybe put it in the housing or but. So if he thinks, you know, the government treasury bills is better off, then obviously, I mean, they'll put their money in that in those investments and go to sleep. And then in the end enjoy some, I mean, more or less, I mean, free struggle, you know, interest rate in the future. So in a situation where the government has appetite for borrowing, you know, interest rate finds it difficult to come down in the banking halls. The bank themselves, you know, put their money in government treasury bills. If you look at the bank's, you know, balance sheet, clearly you see chunk of the upper part being in what, you know, treasury bills in terms of what the asset side. So clearly it gives you the signal that, you know, the government was holding for. So if you look at the promises, they said they'll make the effort to what, reduce interest rates. So I think they saw that, you know, the government's appetite for borrowing is what, holding up the interest rate to a level where it is not able to come down with all the measures put in place. Remember, we had, you know, Ghana reference rate, which, you know, encompasses the monetary policy rate and treasury bill rate 1-to-1, you know, more or less. If it's coming down, we expect that. But then the other side, which is the risk premium, which depends on the borrower, obviously has more or less closely worked on, because we had identification, we had, you know, national ID card and all those. So, you know, whoever is coming to borrow, you can easily identify, be it institution or be it, what do you call it, individual. So effectively, we're expecting reduction. But then, you know, that, you know, effect of government appetite for borrowing was holding up the interest rate. And then the second thing, was holding the interest rate in the banking hall was liquidity. You know, the banks had no money to lend. The little that they have, they need to hold on to it. They cannot lend it, you know, to the market as we expect at a level of interest rate that is relatively low, because financing is scarce. You know, people are not bringing deposit. So it will be difficult for them to do on lending at what, a lower cost. So if these are things that were in the system, and if you look at the manifesto, clearly indicate that they will find a way to what, you know, reduce government borrowing so that, you know, they will energize, you know, the private sector through the banking corridor. So effectively, I think, you know, if you go by the manifesto, you know, they should be able to, I mean, do something like that. But then let's come back to your question, which you asking me about import source and then possible impact of COVID on that import source. Now, we are lucky, I mean, at least vaccines have come up, and in the end, globally, I mean, we're getting a headlight. I mean, if its efficacy is about 95%, it's doing something.
But still, they are locking down.
Yes, of course.
I mean, new variants are being found.
Yes, it's true. But then in the end, we should see that importation, I can tell you, most importation that goes on, you don't need the physical presence of the businessman. But the only problem is the economic activity at the source. Because chunk of the businesses, like I've seen a lot of people going online to place their orders from China, and it is being delivered in this country. So with the digitization and, you know, with the space that we have as far as, you know, the direction of trade is going, I mean, I don't think we're going to have much problem with this traveling of businessmen and all those. I believe that, you know, once the economy start picking up, once we get used to, you know, COVID, and we keep to all those, you know, protocols that has been outlined by the World Health Organization, we should be able to see economic vibrancy. I don't think, you know, that we're going to have much problem as far as importations are concerned.
All right. Let me take the final comments from Professor John Gachi on whether COVID is going to play any role or whether it's going to impact on the plans of government in terms of its revenue generation and an import-driven economy. Prof, your take on that.
Well, I think we've all agreed that COVID has had some toll on economies across the globe, and it will continue to have some toll on economic management. I think what we need to bear in mind is that Ghana is a small, open economy. So we feed into the global economy. We feed into the global supply chain architecture. So our total recovery and effectiveness henceforth will also depend on the effectiveness in other major related countries in terms of where we get our imports, in terms of where we send our goods, in terms of export, etc. But there is an aspect of our economy which at the moment does not depend on the global economy. To a large extent, our production of foodstuff does not to a large extent depend on what is happening in China or what is happening in America. Some level of production does not also depend on what happens in America and the rest. So those aspects we need to guide religiously and ensure that we bring about effectiveness and efficiency so that they continue to keep us as we go along. Our revenue will depend on what happens in other countries because we are a small open economy. Even in terms of capital flow, it will also depend on how their market is responding to the situation before we can have some benefits or outflow of what they have in their economy. So I believe that COVID to a large extent is relevant in economic management henceforth, and we should also not lose guard in terms of the component of our economy that depends on only us within the context of Ghana.
Prof, I'm grateful for your final
submission.
On that note, I'd like to thank every one of you for being a part of the discussion this evening. I've been helped and supported by Professor John Gachi. He is the Dean of the Business School, University of Cape Coast, and Dr. Lord Mensah. He's a senior lecturer at the University of Ghana Finance Department. Gentlemen, I'm grateful you made time to join me this evening. So on that note, I'd like to thank you once again for being a part of the discussion. So there will be a replay of the show tomorrow, God willing, at 10 a.m. on eTV. But I thank you as well for those of you who made time to share the link on your various groups and platforms on Facebook and WhatsApp and Twitter. God willing, next week Tuesday, we'll be back again with another edition of Fact Sheet. My name is Samuel Ishen. Good night.